This is part 2 of the purchase options, and we're going to start this one looking at hire purchase, which might be you want to buy the latest model of computer, can't afford it, so you basically do a deal where you pay a small amount, and then at a later date, it could be 6 or 12 months' time, you start paying regular payments, and they might be $100 a month or $50 a week or something like that. The example that's in the book is a computer with a cash price of $4,800 bought under a hire purchase scheme where you have to pay 25% deposit up front and then later on $148 monthly instalments. So the question basically wants you to calculate the total amount that's paid under the scheme, therefore the total amount of interest, and therefore what actually is the interest per year that's charged. So if we start, the very first thing we have to do is we have to figure out how much we're going to pay all up. So the total amount is going to equal the amount we paid for the deposit plus the monthly instalments. So if we look at this, deposit is 25% of $4,800. So 0.25 times 4,800 is equal to 1,200. So we've paid a deposit of $1,200, and then the monthly instalments, it's really easy because they've told us we have to pay 30 of them and they're each $148. So that is equal to $4,440. So then we can easily find out the total amount paid. So we're going to put this one and this one, and we're going to add them together. So total amount paid is equal to 1,200 plus 4,440, which is equal to 5,640. So that's the first question, or question A, the total amount paid under the scheme. So in the second part of this question, we need to find the total amount of interest paid, and we're going to use the formula. We're going to say interest paid is equal to the total amount we paid over the whole thing minus what the cash price was. So we've already got all the information we need because we know from the last question that the actual total amount we paid was that. And from actually reading the question, we know the cash price was $4,800. So really simply, we're going to go 5,640 minus 4,800, and we're going to find out that we paid $840 in interest. The third part of the question asks us to find the interest rate. So what I've done is I've written down how we would, the formula to find the interest, and then I've written down what I know and what I need to know. So in this case, what I actually need to know is I need to know the interest rate because I actually have all that other information. So I'm missing that one. So I've written down on the side here, we know from a previous question that the actual interest we paid was $840. The principal, or the amount that we loaned, is actually the cash price, so that $4,800 minus our deposit, so $3,600. So supposedly we've borrowed $3,600, and that's what we're paying the interest on. And the time was 30 months because it was 30 monthly payments, which is the same as saying 30 over 12 years, which is the same as saying 2.5 years. So now I'm going to put all that information into the formula that I've got above. So I've got 840 is equal to 3,600 times, and I'm going to put the years in now, 2.5 times R divided by 100. So if I then do a little rearranging and a little bit of maths, so I'm going to go 840 times 100 is equal to 3,600 times 2.5 times R, and then I'm going to go 81.2 is equal to 9,000 times R. Then I'm going to go 84,000 divided by 9,000 is equal to R. So R is equal to 9 1/3%. So the simple interest that I'm paying is 9 1/3%. In the last example, we found that the rate of interest, or the simple rate of interest, or the flat rate of interest on that computer was charged at 9 1/3%. The reason why we're being really careful about saying flat or the simple rate of interest is when you actually look at it closely, the real rate of interest is significantly higher. And this is because with that flat rate of interest, it's charged on the total amount owed, so that's 3,600 over the whole period of repayment. Even though you're paying a little bit of that repayment off each time and it's decreasing, you're still getting charged the interest on the whole 3,600. So we need to find out what we call the effective rate of interest, and there are two formulas that we can use to determine the real or effective rate of interest. The first one we use when we don't know what the flat rate of interest is. So we don't know that we've got this 9 1/3%. And what it basically says is the effective rate of interest is equal to 24 times the total amount of interest paid divided by the principal times by how many months there are, add 1, times by 100. Okay, or you can look at it as 2400I over PM plus 1. Okay, so they're the same thing, it's just I've got rid of that times by 100 by putting it up the top. So that's the first one we could use. The second one we could use when we know what the flat rate of interest is we could use 2 times the number of instalments, that's an N if you don't know, divided by the number of instalments plus 1 times whatever the flat rate is. Okay, so if we look at a situation where we can do both those, I'm going to use this formula first. So using the information that we have been working on in this tutorial, I would go 24,000 times 840, because that was how much interest we paid over the whole time, divided by the principal, which was 3,600, and then I'm going to times that by the number of instalments plus 1. Now if I do all that, I get the effective rate of interest at 18.06%, or almost double the flat rate. If I'll just quickly show you the other way as well. So in this one, I'm going to go, I've got 2 times the number of instalments divided by the number of instalments plus 1 times 9 1/3, which will give me 560 over 31, which also is going to give me 18.06%. So we're actually talking about an effective rate of interest that's double what is probably going to be advertised. So it might be advertised at 9 1/3 simple rate of interest, but behind that the company knows that they're actually charging 18.06% effective interest. The last type of loan that you might be asked about in these is what we call a personal loan, so reducing interest method. I know this really well because my parents always loaned my brothers and I money when we had our first cars, and we had to pay it back. And we would start paying a lot of principal, not much interest, and then as we would get some principal paid off, the actual interest component would increase. So basically we recalculated the interest every time that we made a principal payment, which basically means you don't have to worry about the effective rate of interest. When you get to these types of questions in the book, first of all, you need to read what's on page 360. But the best way to do these ones, and a really effective way, is to use something like Excel. And there is actually a digital document about reducing interest loans that you can access using your textbook. And I'm not going to go through with it here. You actually need to do that yourself because it will make more sense than me trying to show you on this. So that is the end of the purchasing options part of these tutorials. We'll move on to depreciation next.